Good afternoon and welcome to today's webinar from The Times and The Sunday Times. My name is James Coney and I am the money editor of The Times and The Sunday Times. Today's webinar is brought to you in association with Netwealth, and today we will be discussing the most topical item I think we've ever discussed in these webinars, which is beating the squeeze, protecting your investments from inflation, how to keep your retirement money safe among rising living costs. Netwealth is a challenger wealth manager that combines the best elements of traditional wealth management service with the benefits of modern technology enhanced approach. Before we do get started, if you need any tech support through today's events, then please email rsvp@news.co.uk. That is rsvp@news.co.uk. And hopefully somebody will be there to help you sort out any tech problems that you might be having. For today's webinar, I'm very pleased to be joined by Charlotte Ransom, Chief Executive of Netwealth, and Nimesh Shah, Chief Executive of accountancy firm Blick Rothenberg. Both Charlotte and Nimesh will be providing their expertise and a wealth of experience on protecting your investments and answering some of your questions, which I can see already on another screen I've got over here, are already pouring in. And thank you so much for those of you that have already sent questions ahead of today's webinar. Now, I will just remind you that unfortunately we can't answer very specific personal questions or give any kind of financial advice relevant to your personal situation. You need to see a financial advisor or an accountant directly to do that. But what we will try and do is answer some of the more general pertinent points that you're trying to raise. And I'm sure lots of issues which are individual to yourself will be relevant to so many of the people who are watching today. As our event is live, you can click on the Q&A icon on the left-hand side of your screen and we'll get through some of your questions as you go. So let's get started. We are in the most turbulent of financial times at the moment. We have a base rate decision tomorrow, and it looks likely from the reports in the Times today that the Bank of England are under increasing pressure to go even harder on base rate rises, which have already gone from 0.1% to 0.75%. We may get 7 this year, they're talking about, to take base rate to 2.5%. It's going to affect everybody's mortgages, not so much their savings, as we have seen already. We have got stock markets which seem to be all over the place. We've got sell-offs in tech stocks, but we've got the FTSE seems to be doing remarkably well at the moment. We have got CPI inflation at 7% and more inflation figures yet to come. We've got a global supply crisis still. We still don't know the full effects of the war in Ukraine. Lots and lots and lots of cost pressures. Energy bills up already in April, probably going up again in October. What a environment we are in at the moment. And I think, Charlotte, we'll come to you first to hopefully put some context in this for people. What is going on with inflation and how substantial is this to people's finances? And really, how should people be thinking about it in terms of the way that they're investing? There's a lot to unwrap there. You take it step by step.
Yes, thank you, James. Obviously, we are living through a very difficult and volatile time right now. I mean, it all started, I suppose, during the pandemic, which was responsible for significant COVID-related stimulus from central banks around the world who were trying to push liquidity into the markets, raise confidence and prevent a sort of just a complete stopping of all activity. And at the same time, obviously, the pandemic meant that there were all sorts of bottlenecks that started to build up in supply chains, and that started to push prices higher that we saw continue after the pandemic and the lockdowns were released. We were still in the position where a lot of the sort of circulation, if you like, of products and services was still quite constrained. And then, of course, we came into the start of this year and we had Russia's invasion of Ukraine. And what that did was first reinforce the already pre-existing trends and has at the same time driven up commodity prices in particular, such as, oil, natural gas and wheat. And we're all living the consequences of that at the moment. So it is having a direct impact on the UK, obviously, and countries even worse that are more closely allied to the economies in Russia and Ukraine. But we have just hit a all-time high in our consumer price index, which is, something that all of us will feel in different ways. And generally, with the world we're living in now, feels like there is slowing economic growth around the world. There is high inflation, which we would expect to persist, but not necessarily to be permanent. So it's going to be a question of living through inflation while it continues to persist. And also, we are expecting that monetary policy will continue to be tightened. So as you mentioned, the central bank here is talking about raising rates again. In the US, they've been very clear about wanting to continue to raise rates. And so the question is going to be whether or not we have what economists would call a hard or a soft landing. So a soft landing is what would be preferred, and that's when you see a general slowdown in growth, but not recession. And recession is something that now, as we know, is being increasingly talked about as a possibility. So what does that mean for our personal finances? It's obviously a tricky environment. And first of all, I would say that there isn't a single sort of golden bullet here. But one thing that I think still remains very true, and Harry Markowitz, the Nobel Prize winner, once said that there's only one free lunch in investing, and that is diversification. And so what do we mean by that? Really, as investors, we should make sure that our eggs are not all in one basket. And actually, James, in your intro, you talked about the fact that, the US previously had done incredibly well. We know that was led by those big tech stocks, which are hugely dominant in the US market, doing incredibly well, much less well this year. And the FTSE 100 actually is in positive territory for the year and has done much better. So when we think about our portfolios, we would, in a sort of classic 60% equity portfolio, 40% fixed income and other, we would have roughly 20% in the UK, 20% in the US, 10% in Asia, 10% in emerging markets, and maybe just 5% right now in Europe. So that question of being diversified, I think, remains very true. And then, of course, there are assets that we know do better in these circumstances. And commodities is something which is on lots of people's lips. Gold has done well, particularly well in the last 6 months, and is a sort of natural thing for groups like ours to hold to give people that bit of comfort when the environment is as difficult as it is right now. And broader commodities have also done well. And we were holding them last year, and they proved to be really quite effective. But one thing I would say about commodities that's really important to remember is that they don't have any natural yield. So there's no dividend, there's no income that they drive. It's all about their price behavior. And so they are quite tricky as investments. And I think it is something that I would err on the side of caution. And then the other question, I think, arises around property, because most of your listeners will own property, whether it's the home that they live in or whether they've also potentially built up a portfolio of buy-to-lets or property as investment. And so that, I think, contributes to the overall question of being diversified and having property be part of that. But the drawback with property is something that is quite obvious, and that is that it has much higher friction costs, expensive to get in and out of, much longer time frames are required, and it's really quite illiquid. So, if we compare that to the equity markets, for example, which trade on a daily basis, and we can see exactly how they're behaving, it's really a question of making sure you have that nice, diverse mixture of assets to help you get through these difficult times. And in the end, what I think your listeners probably are trying to achieve is over time to drive inflation plus a little bit or plus a little bit more, depending on their timeframes and their financial goals. But the type of returns that will be sufficient to meet those financial goals over a medium to long-term time frame. And of course, when we talk about retirement, it's not the day you retire as much as the time frame during which retirement will last, which is often, years and sometimes decades.
Thanks, Charlotte. I remember sitting down as a young cub reporter, meeting one of my first fund managers, and we were talking about the way that I was investing. I thought I was ever so clever, and I was telling him how brilliantly all of my portfolio had gone up, and he said to me, if all your shares are going up at the same time, you're probably not as good an investor as you think you are. And that was obviously the key point about diversification, because when they all go up, they all certainly went down at the same time as well. It was a valuable lesson learned. And Nimesh, I'll come to you. We've seen obviously lots of changes with taxation going on at the moment that are also going to be affecting people's wallets at the moment. Can you just run us through some of those and why they might be significant?
Yeah, I suppose, James, it's how far we want to go back in time here on tax changes. The more recent changes that the Chancellor Rishi Sunak's brought in, starting in the budget last year, was the freeze on all personal tax allowances. So the personal allowance, the tax-free amount, the basic rate bands, pension allowances, inheritance tax allowances, all of those were frozen for 5 years. And so that was pre-announced around this time last year, and that was for a 5-year period until 2026. And that was, I suppose, before anyone knew that this big inflationary burden was going to be hit the economy. And some may say now, with the benefit of hindsight, that was a very misguided move by the Chancellor. But it was badged as a stealth tax. It was something that no one would see really affect them straight away, but that was assuming that inflation would run a very normal level, that sort of 2% mark that the Bank of England aims for. The impact of those freezing those allowances now is much more pronounced, and it will become even more pronounced as time goes on, because 2026 is still some time away. The other more recent change that we had, and this was announced in October and September, before the budget statement then, was the Health and Social Care Levy. So this was a 1.25% increase on all national insurance rates. So mainly hitting the employed worker, but also hits businesses as well, because businesses, when they employ a worker, they have to pay employers' national insurance, which was 13.8%. So that's increased to over 15% now. And that change took effect from April. So people would have seen in their April pay packets a reduction in the net amount that they could take home. Now, what the Chancellor did in the spring statement back in March was, under pressure to defer or cancel that 1.25% national insurance increase, again with the backdrop of the war in Ukraine, rising prices, energy prices, the opposition certainly said that national insurance increase should be cancelled. What the Chancellor did was quite cute, in my opinion, that he increased the national insurance threshold. So the point at which people do pay national insurance, that was increased to align it with the personal allowance to just over £12,500. Now, strangely, and for reasons that I cannot work out, that increase in the national insurance free threshold only takes effect from July. So people will see a dip in their pay packets from April, but then in July, because the increase in the national insurance threshold takes effect from that point, they'll see for those workers that will benefit from that increase in the threshold, they will see their net pay increase. And the break-even point is around £41,000. So it was a very targeted measure from the Chancellor to make sure that the lower and middle earner, they were benefiting from that increase in the tax-free threshold, the national insurance-free threshold, I should say. But everyone else will be worse off by that 1.25% increase. And just going back to, as well, businesses that are employing workers, and for them to have that increase 1.25% cost, that cost has got to go somewhere, and that's going to be passed on to the consumer in higher prices. So compounding that inflationary aspect that we've all been talking about, that Charlotte was talking about as well.
I think also the important thing about fiscal drag or stealth tax, whatever we call it, is as you say, Nimesh, it's really very, very sneaky in the way that it hits you, doesn't it? Because of course there are several points. You may think of one part of the tax system where it might hit you. Maybe it's the threshold of basic rate to higher rate tax, but then there's also the threshold where you have your personal allowance reduced at £100,000. There's the top rate tax barrier. There's capital gains tax allowances. There's inheritance tax. And with rising asset prices and with pay rises, you're just going to end up paying more tax than you would have done. And that's the crucial thing, isn't it, there? That it's not necessarily a tax rise, it's more tax, being paid more tax than you would have done, more tax for the Treasury. And that's where it's going to really hit you in your pocket.
Yeah, and that's right, James. And we've had stats from HMRC over the last couple of weeks. So record tax receipts in income tax and national insurance. And as you've been talking about, some of those other thresholds that have crept in over the last 10 years. As I said at the very start, how far back do we want to go? I would say that we could go back to the start of the coalition government in 2010, when we saw the 100,000 point when someone loses their personal allowance. So the effective rate of tax becomes 60% in that banding between 100 and about 125,000. Things like child benefit as well, that was brought in 2013. So when someone earns over £50,000, they start getting a clawback on their child benefit allowance. Inheritance tax threshold, the 325,000, that's not risen since 2009. So that will be over 15 years where that threshold, the 325,000, hasn't increased. And the point at which someone pays higher rate tax, 40%. If I go back to when I started practicing tax 20 years ago, to hit the 40% threshold was something of a bit of a milestone, that you'd earned a level of income that pushed you into that level of taxation. So you'd almost sort of made it, really. Now, that threshold is actually quite low. And doing some quick maths, based on the fact that the thresholds aren't going to increase until 2026, the threshold at which someone pays 40% tax has only increased by about £6,500 in the last 15 years. It's about £400 a year. That's a tiny amount when you look at it and compounding it with the inflationary aspect and the higher inflationary aspect that's going on now, at the point at which someone pays 40% tax. So you're absolutely right, James, that fiscal drag impact that people are feeling on taxation, with all those things combined and the more recent changes that Rishi Sunak's introduced, that is going to hit people pretty hard.
Thanks. So look, I think that's a brilliant sum up of where we are. So let's go forward now. What do we do about it? And I think there's some great questions here that we've already had pouring in. We've got Helen Adams asking, how do we protect our money from market and economic downturns but still earn a few percent? Another one, Richard Beasley, I have approximately £200,000, lucky so-and-so, in cash and premium bond savings. Where do I invest to keep safe but fairly accessible? Now, Charlotte, I think those two questions both raise a really interesting point about cash savings and investments, and about the balance between what you should have there. Do you want to just kind of kick us off? Step one, cash, investing, go.
Yeah, I mean, look, this is such an important point to make. And I think it's a sort of fascinating moment for us to just think about this, because when you're living through the type of environment that we are right now, there's something that feels very good about cash. You know, it feels safe, it's guaranteed, but we are guaranteed to lose money on it. With inflation at any level, let alone the kind of elevated level that it is at the moment, you do not want to be sitting in more cash than you need. So as a rough rule of thumb, when people say, how much cash should I hold? We'd probably say, if you're in employment and earning a salary, it's probably roughly 6 months of expenses. And if you're retired, you would probably extend that to a year's worth of cash holdings, just so that you have enough to cover you in the event of, problems that for whatever reason you may encounter. Now, what is absolutely fascinating, I think, is that there is a knee-jerk reaction, it feels to me, in the UK to hold more cash than is necessary. And we were looking actually at the ISA statistics. And so, for example, for the 1920 tax year end, there was £75 billion worth of money put into ISAs. 75% of that is sitting in cash ISAs. And 4 in every 5 new ISA subscribers have put that money into cash. So there's a real problem with that, because you're doing the right thing by making use of the tax-free wrapper, the ISA, but you're not actually putting that money to work to help it drive investment returns. I think one of the things maybe that isn't even perhaps well understood is that it's very easy, once you've put the money in an ISA wrapper, to switch providers, to switch the assets that are in the wrapper. If you opted for a cash ISA, you don't have to sit with a cash ISA forever. And the other really relevant thing is that ISAs on average have holding periods of over 5 years. And so that is clearly a signal that this is money that has time to go be invested in the markets, potentially sit through some volatile times, but over time you would expect to make positive investment returns. So I think that it is absolutely critical for us to think quite carefully about the amount we need and should keep in cash and the amount that we should invest. And then the other thing I would just mention is, I was just talking about ISAs. We need to make sure we all make the most of whatever tax incentives we're being given. So Nimesh was talking about, quite correctly, the rather sort of the cold wind of all the different tax changes that are working against us. But I'm also always interested to find that people don't necessarily make the most of the tax wrappers that are available to them. So ISAs is one really good one. So a family of 4, for example, can now have 20,000 for yourself and your spouse. Let's say they've got 2 kids, that's another 9,000 each that could be put into junior ISAs for children. So that's £58,000 that can be invested tax-free. And actually, over a 10-year period, for example, having it in an ISA versus not, you would work out as having an extra £100,000 on that money. So it's super well worth it. And the same is true, of course, for pensions. So although we can put less into our pensions than we could before, we still do need to make sure that whether it's for ourselves or for spouses, that we are making the most of our ability to save into our pensions, because they still remain a very tax efficient place to put money. And, quite apart from everything else, in the event we don't touch our pensions, they are then inheritance tax free as well, for anyone who is lucky enough to be a beneficiary of someone's pension. So, I think it's just worth remembering it's not just investing, which I think is absolutely critical. It's also making the most of any type of tax planning wrappers that are made available to us to help get our money to stretch that bit further.
And I think that's a really good kind of segue onto a great question we've had here from Samantha Fenton. Which is better for retirement, saving in an ISA or investing in property with a mortgage to rent out? Now, I think Charlotte mentioned at the start, Nimesh, about how many people have property. I mean, I suspect most people here will, watching this, will have had a residential property, their own house, but buy-to-let is obviously very, very key area, but it's obviously had lots and lots of tax changes in the last few years. Lots of people still see property as a thing, but lots of economists these days talk about residential being probably one of the most heavily taxed assets that we have. Just spell out for us the things that you might want to think about if you're thinking about generating investment returns, looking at ISA, pension, and buy-to-let.
Yeah, so let's start with property. And James, I completely agree that property is one of the most heavily taxed assets that we have in the UK, and it's become even more taxed over the last 10 years. Lots of different changes that have come in relation to property taxation. And if we just take the buy-to-let residential property example, which is the most common form and what a lot of people end up doing. So the mortgage interest relief restriction kicked in 2017, and this basically meant that higher rate taxpayers wouldn't be able to benefit from full tax relief on the mortgage interest cost. Now, this may be a bit of a ticking time bomb because interest rates are going up as well. So not only is the cost of your mortgage going up, but also the amount of tax relief you can benefit from is restricted because of those changes that came in. In 2016 as well, the government introduced an additional surcharge for buy-to-let investors, so 3% additional stamp duty on the second property for someone who was investing in a buy-to-let as well. So it became more expensive to acquire a property in the first place, and also stamp duty rates have changed dramatically as well over the last 10 to 15 years. Now, if you are looking at investing in property and you're looking at building a portfolio of property assets, then one of the things that has become more popular because of those changes that I mentioned, especially on mortgage interest relief, is that some people do set up limited companies. Now, I don't think it's worth it for just one single property because there is admin and there's cost filings to do in relation to a company that you'll need an accountant to handle for you. But if you're looking at buying 3, 4, 5 over a passage of time and building that portfolio up, then wrapping things up in a limited company can make sense. Currently, the corporation tax rate is 19%. That does go up next year as part of one of Rishi Sunak's changes that was announced last year to 25%. But you do get full tax deduction for your interest costs currently. But there is a bit of a sting in the tail that if you want to take things out of a company, then you suffer a second layer of taxation, a dividend taxation commonly. And dividend tax rates have gone up. So I didn't mention before, but the Health and Social Care Levy did add another 1.25% on dividend taxes, meaning the top rate of dividend tax is over 39%. And if you compound that with the corporation tax rate, you've got effective rates of tax for higher earners of well over 50% now. So just to watch out that companies, can on paper give you a low rate of taxation in relation to your buy-to-let investments, but how do you get that money out? You can have a second layer of taxation, but there can be a good deferral mechanism. Let's go back to ISAs and pensions. And Charlotte touched on this as well. And my mantra is always to try and keep things as simple as possible. And so before you start getting involved in investment companies or offshore bonds or other types of tax wrappers, there's lots of simple tax wrappers available, which are almost off the shelf, really. So the Humble ISA, which has been around for over 20 years and has had various incarnations now. But I go back to what Charlotte said around people putting cash into a ISA, which I'll let Charlotte comment on the investment consideration. But from a tax perspective, some of that doesn't make sense, especially when interest rates have been so low over the last few years, that people do have tax-free amounts on the amount of interest they can generate personally. If you're a basic rate taxpayer, you can earn £1,000 of interest tax-free. If you're a higher rate taxpayer, £500. So wrapping those things in a cash ISA doesn't intuitively make sense, but a stocks and shares ISA could make sense because an ISA does block capital gains tax, income tax on higher rates of or higher yielding fixed income type assets or dividends as well. But remember, you do have a dividend allowance of £2,000 that you can take advantage of. But the ISA is one of those things as well that if you don't use it, you lose it. So there's no carry forward or carry back. And as Charlotte was mentioning, you can maximize allowances over the family as well. And this is something that I certainly asked my sister to do when my niece was born. So she's coming up to 11 years old, and I always use this anecdote that I gave my sister some tax advice around them buying her a buggy or a pram when my niece was born, and I worked out that my niece could have in a stakeholder pension, so £2,880, which is topped up by another £720, so £3,600 plus that junior ISA amount of £9,000, using a very conservative rate of return of about 3%. I worked out that my niece will have about $250,000 by the time she turns 18, and that is a huge sum of money. And I know that if I'd had $250,000 stashed away, I would have had a very different time at university to what I did have. But it could be used for a house purchase or university education in the future. So don't underestimate the power of that tax wrapper, starting early amongst the family as well, and protecting from what I talked about at the very start, about that fiscal drag, and also tax is a wealth eroder. So anything we can do to wrap assets in those ISAs can be very valuable. Just finishing off on the ISA as well, the government introduced a few years ago the lifetime ISA. So if you are young enough, so under 40, but over 18, you can put £4,000 of your ISA allowance of the 20,000 component into a lifetime ISA. The government tops that up by £1,000, so you get £21,000 across your total ISA allowances, and you can carry on contributing to the lifetime ISA until you're 50, but you have to open one before you turn 40, otherwise you can't benefit from that. And so someone who's 18 could generate £32,000 of free money from the government just through using the lifetime ISA limits. But the sting in the tail here is that if you need to get the money out, there is a penalty. There's a 25% penalty to take the money out, unless you take it out for retirement, which for lifetime ISA rules is 60, or you use the money to buy your first property as well. So for me, again, the ISA, the lifetime ISA, is a very long-term investment vehicle. I think that is quite common from what I see, and again, Charlotte alluded to this before. I think someone would rather sell their grandparents than cash in their ISA. They tend to be very, very long-term vehicles. And then finally, James, you mentioned about pensions as well, and again, in the spirit of trying to keep things simple. And this is where people can do things around that health and social care levy. So contributing to a pension, most people have a £40,000 annual allowance on a pension. So you can salary sacrifice into a pension if your employer allows you to do that. If you've got some bonuses coming up as well, that may be a neat way of pushing more into your pension as well. And you will save some of the you will save the national insurance on salary sacrificing. Your employer also gets a benefit as well, because that isn't an amount which is subject to the employer's national insurance as well. So there's a higher saving there for your employer if you're that way inclined. Or they may split the saving with you. Some businesses do that. We do that here at Blick Rothenberg. So we share that saving with our employees. But you do need to watch out for other limits with the pension as well. So the amount you can build up in a pension now is capped to 1.73 million. Again, with the spirit of the freezing of all of those allowances that Rishi Sunak brought in a couple of years ago, that is frozen until 2026. If you breach that limit, when you start withdrawing from the pension, there can be a much higher penal tax charge, the lifetime allowance charge as it's known, which is a 55% tax charge on the surplus beyond that lifetime limit. So you do need to do some maths to make sure that you don't breach that amount in terms of how much you're contributing the investment growth up until the point that you start withdrawing from that pension. But whilst the money is in the pension, very much like the ISA, it can grow tax-free. The difference between a pension and an ISA, which I get asked about a lot, is that you get tax relief on the way in for a pension, but you are taxed on the way out. With an ISA, you don't get any tax relief on the way in, but you can withdraw from that ISA whenever you want, other than the lifetime ISA, without any penalty other than that lifetime ISA that I talked about. So hopefully that gives everyone a bit of a summary of those three asset classes.
And I think the really interesting thing, Nimesh, is that what you were saying about the lifetime allowance of 1.073 million is that it sounds like a lot of money, but it can quickly become quite achievable if you save regularly from a young age. The benefits of compound growth can mean you hit that allowance. So it's really something you have to think about. I'm just going to reminder for everybody that you can give us questions if you'd like that. I know I've got some coming in already. You can click on the Q&A icon on the left-hand side of your screen and type in a question, and hopefully we'll be able to answer it. Now, Charlotte, I'm going to ask you a personal question. So I'm 45 years old, right? So I am closer to retirement than I am to the start of my career, even though the start of my career feels like yesterday and retirement feels like a million miles away. How much do I need to retire on? What's going to be? That's the question I always get asked from everybody whenever I see anybody. They always say, what do I need in my pension to retire comfortably? I mean, I think it's particularly interesting given a rising inflationary environment, because it's something, it really puts a consideration on how much and how far you need your money to go. So go on, Charlotte, tell me how much I need. Tell me what I should be doing midway through my career.
Well, this is something which is, front of everybody's mind. And actually, if it's not, it's something they should be thinking about, sort of almost no matter what age. But of course, it's once, we're in our 40s. And by the way, I'm closer to retirement than you are from an age perspective, that it's important to start thinking about this stuff. And actually, as you said, particularly understanding the different variables that may impact how much money you need. So when do you think you're going to retire? How long do you think you'll be retired for? How much do you think you are likely to need to be able to spend? Do you think you're going to pass money on during your retirement to dependents and to children, for example, or are you expecting to leave it all in your will to the extent that there's anything left? So there's a lot of different variables. And I mean, just to give you a sense as well as to the impact that things like a change in inflation can have. I don't know how much, different listeners are thinking they would need as an annual income in retirement. But let's take the example of someone who's, say, 55, they're looking to retire when they're 65, and they want that pot to last until they're 90. If they are looking for a £35,000 gross income, then at 2% inflation, that could be funded with roughly speaking about £500,000 going into a retirement pot up front, and then contributing for the next 10 years while they're still at work between 55 and 65, another £10,000 per annum, for example. Now, if inflation, on the other hand, averages out at about 4% rather than 2%, that pot, which was due to last them until they were 90, is reduced down to roughly 83. So you lose 7 years of value from that pot. So inflation is one of the measures which can have a significant impact. And what I would say, and what we do all the time with clients that we are working with, is to help them understand what do those different variables that I outlined at the start, what impact do they have? What can I do about it? So, of course, what may be done here is you may say, okay, I might work for longer. So rather than retire at 65, maybe I have to retire at 70. Or maybe rather than funding it with a £500,000 sort of retirement pot at the outset, it's going to need to be more like £700,000. But not everyone, of course, has the ability to put more in or to think about putting that much more in. So it's very important to understand those different variables. But I'm going to mention something else, which I think is simply not well understood in terms of how you can impact your retirement pot. And that is to think about how much you're paying whoever is managing that pot or those pots for you. And just to give you a sense of going back to that example of that pot lasting to age 90, or being reduced down to age 83 in the event that inflation is 4%, if you're able to pay your provider 1% less than you currently are in annual fees, then that pot extends back out to age 88. So in other words, 1% per annum saving in annual fees is worth about 5 years in the example of the retirement pot we were discussing. And that is something which I think is so critical for people to understand. I mean, the reason I use 1% is because typically, in the way Netwealth was set up, as you said at the outset, was to provide a lower cost, more modern approach to wealth management. And so people coming to us will save typically at least 1% per annum. And that actually can have a dramatic effect on the ultimate outcome of, your retirement plans or your, other types of financial futures. And it's what I would put down to, and we sometimes talk about controlling the controllables. So we can't control inflation. We can't control investment markets. We can make sure we're diversified. We can make sure we don't sit in cash. And we absolutely should make sure that we understand how much we're paying whoever is providing an investment service for us. And can we get that cost down significantly in order to help, meet those retirement goals and to beat the squeeze that we're talking about today?
And I'm going to come to you again, Charlotte, here, because we've got quite a few questions, all on the kind of very similar theme. And you mentioned diversification, and I think and you mentioned bonds earlier as well. So we've got Neil Robertson, who's emailed from the Q&A. Should I move my investment away from bonds and into stocks and shares? We've got Constantine Zafire, sorry if I've mispronounced your surname. My SIP is 1/3 invested and 2/3 in cash. At my age of 77, is it the right split to avoid risks and no time for recovery? I would like to leave it all to my wife and 2 sons as I have other income in retirement. There's lots and lots of questions here about bonds, equities. I think people are particularly thinking about bonds. We've got US Treasuries, obviously, going up quite high, the yield on those. So bonds is really on people's minds. Just explain to us all how we should be thinking in this environment about the split between bonds and equities and how we should be invested at different times of our life. And then, Nimish, I'll come to you about the kind of tax planning aspect, because we've got quite a few questions coming in about that.
Yeah, so the first thing to remind people of is that retirement is a long run thing. So that it's definitely not correct to think at the point that I retire, I now need to be in something low risk, which would mean fixed income rather than equities. Because if you've got a retirement that's going to span maybe 2 decades or 3 decades, there is plenty of time to let that retirement pot grow, alongside the equity markets, taking the volatility that may well come alongside that, but recover from volatility, and over time drive much higher returns than you would expect to earn in a pure fixed income or bond portfolio. What has classically been the advice is that as you get older, your portfolio should shift from being more heavily equity dominated to more heavily fixed income dominated. And one of the problems we find ourselves with right now is that because interest rates are so low, it means that whatever that fixed income component is, you will by definition be getting quite a low return. And added to that is the problem that as interest rates go up, as yields go up on bonds, prices go down. And therefore, there may be an impact as well in terms of the sort of overall mark to market or valuation of that pension pot. So I think I would be very thoughtful about the time frame, first and foremost. So for the first question you asked, I don't know how old the person asking the question is, but I would suggest that there is every reason to think quite carefully about making sure you have an element of equity in the portfolio, and potentially a dominant element of equity for some time, particularly if you're relatively early on in retirement. Interestingly, the second question that you asked, I think the questioner is 77 years old, you mentioned, but has also said that they're looking to pass their pension on to their wife and children and actually have other investments that they're living from. And therefore, I think you said they may be 2/3 in cash and 1/3 invested. That to me, and again, I will remind people we're not giving financial advice here, but if someone were to come to me at Netwealth and talk to me about that, I would certainly suggest that is the wrong balance, because in this event, the questioner is actually living off other income. They're looking to use their pension to provide an income and assets to dependents. And therefore, the timeframes, by the sound of it, are much longer. And there's every reason to try to make that asset, which we've talked about is a very tax efficient asset, also produce investment returns rather than it sitting in cash, where right now, cash rates, you're getting 0.5%, possibly 1% at best in sort of cash deposits, certainly on any sort of considerable notional amount. So hopefully that answers the question, James, in terms of how people might want to think about those different asset classes. And like I said, timeframes are probably the single most important thing to take into consideration here.
I'm really interested to see that we've got lots and lots of questions about inheritance tax planning, actually, and far more than we've had in any other webinar that we've done. And I'm wondering if everybody watching out there it's more on their minds, because of course everyone's worried about the younger generations and with student loans being so large and the terrible few years that lots of graduates have had. I wonder, actually, my gut feeling is that people are a lot more concerned about passing assets down than they have been before to help out other generations. Because of course we've just talked about passing on assets to wife and sons there. I have got a question here about whether or not somebody should sell their Morris Downey. Should they sell a buy-to-let property and gift the proceeds to our children and grandchildren? I've got Stuart Crichton asking about the additional tax burdens of the lifetime allowance and inheritance once you reach the age of 75 on a pension, presumably. Nimesh, if people are wanting to try and help other generations with a better inheritance tax planning at this kind of time, trying to help them with their own cost of living, what are the considerations you should be thinking about in terms of your pension and in terms of your in terms of property?
Yeah, I suppose I'd start by saying that there's no silver bullet with inheritance tax planning, and this has always been the case with IHT since it was introduced sort of almost over 40 years ago now. That it's a combination of lots of different planning techniques that will address the inheritance tax burden. Now, if you want to be a little bit smart about this, the best way to save inheritance tax is to spend it all, enjoy it during your lifetime, or give it all away, so you don't have any assets, or you have assets that are below that nil rate band of 325,000, or if you're a married couple, 650,000. But you can get a top up to $1 million if you include the main residence as well. Now, if you want to be particularly generous to children, grandchildren, to help them with the cost of living burden that they're facing right now, then a gifting strategy does make sense. So there are some small allowances that people can use. £3,000 a year, you can carry forward 1 year's worth, and this is a gifting allowance per person. So a married couple could give £6,000 between them to their children. And there's also a very useful exemption as well around gifting, which is the normal gifts out of expenditure exemption. So this means that someone can give away excess income that they have outside of their normal expenses. And those gifts that people do make, they are completely exempt from inheritance tax. Now, the normal default rule that people will be familiar with is when you make a gift, you have to survive 7 years. But if you're using that exemption, then there's no 7-year tail. So a gifting strategy using that exemption, using the small allowances that I talked about, spending it as well, planning for the retirement events. And again, Charlotte mentioned this, that the pension should be the last asset that you touch from an inheritance tax perspective, subject to the lifetime allowance, so that that asset, that tax wrapper is outside of your estate for inheritance tax. Drawing down using those other assets, that would be the sensible way to achieve this. But then, say there are other strategies that you can get smarter with. Things like using business property relief assets. So AIM stocks, a lot of AIM stocks can qualify for business property relief, which can relieve you from inheritance tax. Taking some life insurance as well. And I'm sure Charlotte can talk more about this, but life insurance premiums have been quite competitively priced. It's a low risk inheritance tax strategy as well. The only thing I'd sort of finish on around inheritance tax is we get asked lots of questions about the family home, which tends to be the most valuable asset in someone's estate. And my rule is always not to plan or mess around with the family home. It's the home. It's something that you want to live in, and it's something you want to benefit from. There were tax schemes that say we didn't get involved in as a firm, and myself as an advisor didn't believe in, but there were some schemes many years ago which have been closed down by HMRC, which should have quite penal tax charges associated with them with the family home. But my advice would be not to really mess around with the family home. It's the one asset that you should protect and preserve, and it's the roof over your head when it comes to any sort of tax planning.
And I think that comes, of course, Charlotte, go on, please.
Sorry. I was just going to say something that comes up quite a lot with people, just around the inheritance tax planning is, as you say, more and more people are really trying to think about how they can help the next generation. And one thing I would just say as a reminder to people is the most important thing to do first, in order to be able to do that, is to know how much you need. The reason I thought I'd raise it is because we did some research recently, and it was quite interesting to see the findings from people who had retired and looking at some of the things that they had underestimated. So of people who were 75% and over, a quarter of them had underestimated how long they'd be retired for, and also the fact that they had needed advice and hadn't taken it. And a lot of them, almost half of them, wished they'd been better prepared for costs that were coming up in later retirement, from over the age of 75, typically to do with health and care costs. And that also contrasts quite interestingly with pre-retirees, where we've actually found that only half of pre-retirees have really started to understand how much money they think they're going to need. So I think bundled together with what Nimesh was talking about is just remembering that the most important thing is to possibly sit down with an advisor if that's the way that people will feel most comfortable. But it is to make sure you're thinking through those different aspects for yourself in order to make sure that then you're in the best position possible to think about the next generation. Because obviously the last thing you want is to hand money over and then realize you've actually been left short yourself. And I think, given longevity, that, everyone is more conscious of these days, the probability that people actually, live longer than they were expecting and actually could potentially outlive their pensions is a risk that you don't want to run into. So just make sure that planning is done in the context of what you're going to need yourself, and then think about the next generation.
And just keeping it simple. I think that was Nimesh's point, isn't it, as well? Just keeping it as simple as possible with your tax planning. I mean, we always work by the principle at the Times and Sunday Times that if it smells a bit funny, if it looks a bit funny, then it might be a bit funny. So just try and use your own kind of personal judgment as well. I got some really interesting questions, Charlotte. I'll put these to you. It might be the last questions we get to take, actually, because we're running quite short. But Mr. Ian Rossiter, can a tracker fund do the job of a fund manager? And we've got P. Martin. Thank you for explaining the different investment wrappers, asset classes, and tax considerations. It leaves one question, I guess. How on earth does one choose which fund, investment trust, or other instrument to invest in? Charlotte.
Yes. Well, they are great questions. Maybe just to talk first of all about active versus passive. So an active fund manager will typically set themselves a benchmark that they say they will outperform. And in order for them to do that, they will typically charge a higher fee on the basis that they are stock picking and they are aiming to outperform that given index. A tracker fund, as the name suggests, is tracking an index. So it might be the FTSE 100 or the FTSE 250 or the S&P and so on. So the indices that these tracker funds now are prevalent around the world, are easy to access. They trade on very tight bid-offer spreads, and they are liquid. So what we found is that typically we will use what I call active asset allocation, going back to that point about diversification, deciding where to invest globally, what proportion to put into different markets, and how to change that over time. But we like to invest using trackers. And the reason we like to do that is because over time, what has been proven to be the case over and over again is that it's incredibly hard for active managers to outperform the market once you take their fee into account. And actually, interestingly, a lot of commentators have suggested that perhaps when markets are more volatile, that's the time when stock pickers should be doing better. And actually, what we found over the first 3 or 4 months of this year is that active managers have once again underperformed passive investments. So I think that, it speaks for itself. It's certainly the route that we've taken so far is to use tracker funds or passive funds in order to implement our views on the market on behalf of our clients. In terms of where you go, well, there are platforms where you can do it yourself, and you'll all know the big names that the Times talks about frequently. So whether it's Hargreaves or Interactive or AJ Bell. I think one of the problems perhaps with those platforms, and certainly we find it with people who come to us, is there is so much choice, and all of the emphasis is down to you to make a decision about what to invest in. And one of the things that we know has been a problem in the past is that people have got a bit caught up in sort of the star trader appeal. So I'll use the example of Woodford because we'll probably all be pretty familiar with that story of a star fund manager who was renowned for producing fantastic returns until the point he didn't, and the bubble burst, and it turned out that things were not quite as they seemed. So I think for people who don't feel like doing it themselves, there are groups like ours who are really trying to get the benefits of passive funds, but are using their in-house expertise to provide that active asset allocation and do it for you. And actually, the other thing that I would just say is that what's interesting to me also about the DIY platforms, and again, it depends on which group you work with, but going back to the pricing question that I talked about earlier, it is quite important to make sure you know what the costs are for doing it yourself, because a bit like, when we all go off to, the south of France or Spain or wherever it is we go by EasyJet or one of the other low-cost planes, and then you find, actually, I've got to pay for my seat and pay for my baggage and pay for this to get easy, quick boarding and so on. And the costs mount up. And interestingly, I think in DIY investing, the same is sometimes true. Once you've paid for the platform where you're going to hold the investments, once you've paid for the underlying, fund manager or fund managers that you've chosen, maybe there's another admin charge and so on. So just make sure that, particularly if you're going about this yourself and putting all the hard work in, try to make sure that you're not overpaying for that, because then you've got to not only have the headache of making your own decisions, but you also might find that the charges are reasonably high.
And I'm afraid I think that's all we've got time for today. We're running out of time quite quickly. I'm really sorry to all of the readers who I can see emailing in with their questions. I'll tell you what, I mean, there's some brilliant questions in there that we haven't unfortunately got round time to. We'll try to answer some of them in the Times and the Sunday Times over the next few weeks, because I think there's some really great relevant issues there. I'd like to really thank Charlotte and Nimesh for your expertise today, and for really kind of shedding some light on some really tricky subjects at this time. There's quite clearly a lot on people's minds. And I think the most important points that you guys were making was that I've taken away from this is, one, keeping it simple is really, really important. That at this time where you've got growing risks in the economy and the way that inflation can eat away at your investments, it really pays to use your tax wrappers to get the maximum advantage, to make your money stretch as far as it can possibly go. Keeping your investments as simple as possible so that you're keeping your costs down, and trying to understand for yourself whether or not you need advice or whether or not you feel comfortable going it alone. But a key consideration in all of that is to think about your costs. And the other thing is to stay diversified as much as possible. As I said before, the great lesson that the fund manager taught me is that if all your investments are going up at the same time, then they're probably all going to go down at the same time. So you really need to think about sensibly about where your money is going. And Charlotte, your brilliant point about how old you are and how long you're going to need your pension pot to keep going for. So thank you so much, everybody out there, for all your questions. I really hope that was informative. There's always so much to take away when you get brilliant experts like Charlotte and Nimesh on hand. This, I think, is certainly going to be a very, very tough year for lots of people investing, because the stock market really has been incredibly volatile so far. And trying to plot a course through it is very hard, particularly if you have a limited investment as you approach retirement. As Charlotte's point in particular about taking a midlife MOT, taking a check on your investments and where they're going, I think was particularly pertinent. And finally, it's just up to me to say thank you to all of you out there for all your questions again, which are really, really helpful in helping us shape these webinars. I really hope you enjoyed it. If possible, please could you complete the feedback form, which is going to be on the left-hand side of your screen, probably near where the Q&A button was, just to let us know what you felt of the event, if there's any changes that you'd like, any other kind of subject areas that you'd like us to do, or any check problems that you may have had. Please do fill it out and let us know how much you enjoyed it. And thanks again for joining us today. Please do keep reading the Times and the Sunday Times. We will help you get through this cost of living crisis by hook or by crook. Please keep writing to us and sending us your questions. In the meantime, have a really brilliant day.